All right, we're talking about sales of partnership interests. We got lime, lemon, and orange are equal partners in the Skittles Limited Liability Partnership. They formed the business several years ago by contributing cash. On January 1st this year, Lime's outside basis is $250, and Skittles' balance sheet, including fair market values, is as follows. So we've got a bunch of different types of assets. We've got some liabilities. We've got the capital accounts of lime, lemon, and orange. On January 1st of this year, Lime sells her entire interest to a new partner, Green Apple, for $500 cash. Assume that Skittles purchased the machine 3 years ago for $120, and that $120 in depreciation has been taken on the building since its acquisition 5 years ago. What are the tax consequences to each partner and the partnership on the sale purchase by Lime and Green Apple? Let's start there. Let's just start by looking at the seller, because it doesn't matter who you're looking at. When you're focusing on the consequences of a sale purchase of a partnership interest, I always start the seller. So remember that when it comes to the seller, there's a 3-step process. So the seller here is Lime. Lime is selling her interest for $500 cash to Green Apple. There's 3 steps. The first step is we go to section 1001 because we have a sale of a property, piece of property, right? Partnership interest is property. We calculate the amount realized minus the adjusted basis to give us the realized gain. And then under section 1001C, because we're receiving cash, it's going to be all recognized because there's no non-recognition rule that applies whenever you receive all cash. So let's calculate the amount realized with respect to Lime. So amount realized is made of 4 things: actual cash, constructive cash or liability relief, fair market value of non-cash property, minus selling expenses. So first thing is we know that Lime is getting $500 of actual cash. So we have $500 of actual cash, plus the partnership is showing a total of $150 of liabilities. Now, Lime, lemon, and orange are all equal partners. We've gone through in previous discussion liability allocation. If all 3 of these partners are equal when it comes to profit, loss, and everything else, capital, you're going to have 1/3, 1/3, 1/3 with respect to everything. Okay? So we're going to take 1/3 of the $150, and Lime's portion of that liability at this date is $50. So because Lime is leaving the partnership, Lime is no longer responsible for this $50. Think about if the partnership went belly up, went out of business, Lime would be responsible for $50 of that. Guess what? Lime's no longer responsible. So that's liability relief of $50. So the total amount realized that Lime gets in this problem is $550. Now, the adjusted basis of Lime's partnership interest is the outside basis at the time of the sale. We're told it's $250. But another way to calculate this, and you can't always do this because if you have revaluations, you have issues with the capital account revalues and other discrepancies. Another way to get this number, this $250, we've got the tax book, $200 for Lime, and then again, $50 for the liability portion, that's $250. But we're given the outside basis of $250. So the realized and recognized gain that Lime records is $300, right? $550 minus $250 is $300. That is the realized and recognized gain under section 1001. Okay, that's our first step. We got 2 more steps. The second step is to determine if there's any portion of hot assets. Hot assets just mean is there any ordinary income or ordinary loss off this transaction? Because the general rule is under section 741 that the sale of partnership interest is a capital gain, capital loss. So that's why we stop at step 2 before we go to step 3 and then determine the rest as 741 capital gain. Let's go through our list of assets. Do we have any hot assets? We're looking for hot assets under 751C and 751D. Now, when it comes to 751A, which is where we find the sales of partnership interests, all inventory, not substantially appreciated, all inventory is included in this, even if it's lost inventory. Hey, we got inventory, so right there. Accounts receivable as well. Accounts receivable are also considered hot assets under 751C, 751D, unrealized receivables. Okay, cash is not a hot asset because we wouldn't even create a gain or loss anyways because always the face value is the basis. Machinery, that's questionable. Unrealized receivables include Section 1245 recapture. Now, there's no 704C issues in this problem because they all formed a business several years ago by contributing cash. No 704C issues. So that means the business acquired this machinery. And we're even told that Skittles, the partnership, purchased the machinery 3 years ago, and we're told that the basis now is $55. So in determining the 1245 portion, we take the 120 purchase price on an adjusted basis, right, when you purchased it, minus the 55, that gives us 65 depreciation taken. Depreciation taken on the respective asset, okay? So 65 depreciation. Now, for purposes of Section 1245, it's the lesser of the realized recognized gain, which if the partnership were to sell the asset here, they would receive, based on the fair market value, 100 amount realized minus 55 adjusted basis. That's a $45 gain. The lesser of the $45 realized recognized gain and the depreciation of 65 would be the 45. So the entire machinery is Section 1245 at this time. So all of it. Is the building considered a 751C or 751D unrealized receivable? No. Okay, building, there's no Section 1250 recapture here. We're not assuming this business was acquired before 1987. And then unrecaptured Section 1250 is not an issue. Stock and goodwill is not going to create hot assets either. So we've got 3 hot assets in this problem. So the hot asset, first, we've got the account receivable. Second, the inventory. And third, we've got the machinery. And again, because the entire portion of potential gain, if the partnership was to sell it, right, you take the lesser of those two. That's the hot asset portion. 45 versus 65. We pick the lesser of those two numbers, and the 45 is the lesser, which is the entire gain. So in order to determine the portion of hot assets for Lime, we take each asset, and we take the fair market value, which we're going to assume hypothetically, hey, the partnership is going to deem sell this asset this time using fair market value. So accounts receivable fair market value at this date is 60. Inventory fair market value is 150. And machinery is 100. We subtract away the adjusted basis the partnership has at this date. That's 75, 90, and 55. And we calculate the realized gain or loss in the calculation. So this is going to be for accounts receivable a $15 loss. Inventory, we have a $60 gain. And for machinery, a $45 gain. Now, the next step is to take the exiting partner, the selling partner's partnership interest at this date, which is 1/3, right? Lime owns 1/3, and multiply it by that. So that's going to be for accounts receivable, $15 loss times 1/3 is a $5 loss. 60 times 1/3 is 20. And then 45 times 1/3 is 15. Next, we sum up those 3 items, or all the items. By summing those items, we're going to get 30, right? This equals 30. That amount is ordinary income or ordinary loss. So this is ordinary gain or ordinary income of 30. Okay, that is step 2. We finished step 2. Now we go to step 3. Step 3 is to take the amount from step 1, which is 300, minus the amount from step 2, which is 30, and that gives us 270, and that is the Section 741 capital gain. Now the problem tells us that they formed the business several years ago, so we can deem, or it's pretty reasonable to assume, that this partnership interest, the entire amount, has been held for more than a year. So this is going to be a long-term capital gain of $270 to Lime. And of course, we've got the $30 of ordinary income. So again, let's just summarize what we did. Step 1 is to calculate the total gain under Section 1001, which was $300. Step 2 is to break out a portion of that total gain as ordinary income or ordinary loss, and step 3 is the remaining portion is long-term capital gain. Now in this example, right, we saw $300 total gain, and 30 of that was ordinary income, and then the rest, 270, was long-term capital gain or capital gain. It's possible, if I change up the facts, I could give you a situation where, hey, Lime could have a $300 gain, ordinary loss of, let's say, I don't know, make up a number, 10. And then, of course, if you did step 1 minus step 2, you'd actually get 310 of long-term capital gain. That can happen. That is possible. Okay? You can actually have more gain in step 3 than in step 1. Because, again, as you saw with the accounts receivable, it created a loss. What if accounts receivable was the only asset here? Then we'd have a $5 ordinary loss. We have 305 long-term capital gain. So that is possible. So just keep that in mind. And don't think like, oh, I'm doing this on an exam, calculation, CPA exam, whatever it is. And hey, I got a loss on step 2. I don't know what to do in step 3. You just follow the same steps. Another issue is just keep all the facts the same. And let's just say that I keep it simple. I told you that the machinery has $30 of depreciation on it, not the 65 we calculated. Well, again, it's the lesser of the two numbers. The lesser of the two numbers, so you would use 30 here. Again, this would change. Okay? You take 30 times 1/3, that would be 10, and that would, of course, change your numbers around significantly. Then this number would become 25 here for ordinary. But I just want to give you that heads up that when you're calculating, again, it's the lesser of. Here, the lesser, of course, was the entire amount of gain, but you do the lesser of the depreciation. That would be recaptured or the realized recognized gain in that situation. All right. So that is the consequences. The seller, that's always where you start. By the way, are there any consequences to the partnership? No. When it comes to the sale of partnership interest, everything is done outside the partnership. If the partnership was involved, that would be a distribution, and we're going to see the consequences of distribution in a later topic. That's under section 731, 732, 733, those rules. Now we're moving on to the buyer, the consequences to the buyer. All right. Well, at this point in time, we're not told anything about a 754 election being made. We're not told anything. So this is actually really easy for the buyer. The consequences to the buyer, right? The buyer here is Green Apple. Green Apple is purchasing Lime's interest, the entire interest. Under section 742, the buyer takes a cost basis in the amount paid. So Green Apple is paying $500, so we start there, right, 742. But remember, liabilities. We've talked about liabilities a lot. Liabilities, the allocation changes all the time. With this new partner coming in, we have to reallocate the liabilities when the new partner joins the partnership among lemon, orange, and green apple. Again, if we're going by just simply everything is split equally, capital losses and profits, and there's no special situations with non-recourse liabilities, all that good stuff. Guess what? $50 of the liability, 1/3, right? 1/3 of the liability under 752 gets allocated to Green Apple. So, end of the day, Green Apple's basis is going to be $550. What about everything else? So that's the outside basis. What about inside basis issues? Because remember, when we do 721, 722, 723 on formation, we have to look at all those consequences. We always drew up the balance sheet. The good news here is that, hey, look at this. We've already got our balance sheet created for us, so it saves a lot of time and energy. So let me erase balance sheet because we're going to write some stuff up. All right, this is now Green Apple's $50 of liability, so let's change that. So let's put GA for Green Apple. That's 50 right there. If there's no 754 election in place, Section 754 election, if there's no Section 754 election in place, which we're not told so far in the problem, right? Because these two are independent situations. So nothing tells us 754 in the original fact pattern. Green Apple, yes, takes an outside basis of 550. But for purposes of inside basis and capital accounts and all this stuff, All we do, we take Lime and we replace Lime with Green Apple. Everything else stays the same. Some of you are wondering, well, how could that be? That is how everything works out. And to illustrate the disparity that creates, let's jump to the next part of the problem. So that is the answer to that part. If there's no 754 election in place, which we're not told, Green Apple takes a $550 basis in the partnership interest outside basis. All the assets keep the same bases, right? Because no assets is gone. Green Apple literally just takes the shoes of Lime inside the partnership. So Green Apple's capital account is $200, fair market value is $500. It's still the same. Now we're moving over to if Green Apple sells the interest 3 years later for $500, what are the tax consequences to each partner and the partnership on the sale purchased by Green Apple? And it's saying, assume unrealistically, hey, nothing has changed. No transactions have occurred. It's just been a holding company, okay? Just to make it simple to show you what happens. Obviously, we know that if this is a real business, it's going to have some differences, some changes. But to keep it simple, I don't want to make it too involved. And also ignore cost recovery. So everything is the same as it was 3 years ago when Green Apple joined. So first, we're going to start by saying if there's no 754 election in place made by the partnership. And by the way, the partnership is the one that makes the 754 election. The partnership does. Okay. So now Green Apple is selling his or her interest for $500. Well, guess what? We do the same 3-step process we do with Lime. Step 1, we calculate amount realized minus the adjusted basis. If Green Apple sells the interest for $500, it's going to be exactly the same as Lime, right, in terms of amount realized. It's going to be the $500 of cash received plus the liability relief. We've got amount realized of $550. However, the adjusted basis of Green Apple is different than Lime. Remember, the outside basis we determined is $550. So minus $550. So step 1 is 0. Realize gain or loss and recognize gain or loss under step 1 of 0. Okay? And yes, I said realize and recognize, but that's just under step 1. Now you're going to see the interesting part. Step 2 comes. Guess what happens? We got to go through the hot asset analysis again. If Green Apple steps into the shoes of Lime exactly the way it was and nothing changed, this analysis is identical. That means that you go through the same thing. The accounts receivable, inventory, machinery, boom, it's all the same, which means that under step 2, Green Apple has ordinary income of $30. That's how the tax law works. Finally, we get to step 3. So that's a 751 analysis. Green Apple has a $30 ordinary gain. 751A. Finally, we get to step 3, the 741 analysis. We take step 1 minus step 2. Step 1 was 0. Step 2 is 30 minus 30. The 741 capital loss, specifically a long-term capital loss because Green Apple has held the interest for 3 years, $30, a $30 capital loss. This is the worst situation you can have because in all of tax world because you have an ordinary gain and a long-term capital loss, which, as you all know, capital losses are severely limited. Severely limited. So when we say that Green Apple steps into the shoes of Lime, we really mean it. The only thing that changes is that Green Apple takes that different basis in the partnership interest, that $550 rather than Lime's $250 basis. But everything else stays the same. So Green Apple, in this situation, right, of no 754 election, if there's no 754 election made by the partnership, Green Apple is going to have to report an ordinary gain of $30 and a long-term capital loss under Section 741 of $30. That's bad. Yeah, it nets to 0, But as you all know, ordinary income is subject to higher rates than capital gains, and then capital losses are much more severely limited than ordinary losses are. So that's what the 754 election fixes. It makes sure this situation does not happen. Okay? Now I'm going to use a different color. Let's use green. All right. So the 754 election's in place, which is the next part of the problem. We just did that part. If the 754 election is in place, we do the same 3 steps we just did. However, step 2 is going to be different. And the reason why it's going to be different is because under a 754 election, let's say a 754 election was made since the beginning. So even when Green Apple purchased the interest from Lime, that was always in place since Green Apple's been around. The 754 election's been there. Then what happens is we have to adjust each asset for Green Apple. So what we do is we go through each of the assets. We start with cash, accounts receivable, inventory, machinery, building, stock, goodwill. We go through each one. We do a similar analysis like we did in step 2, but for each asset. And by the way, this is a very, 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 very simple example of a 754 adjustment. 754 makes things extremely difficult. So we take the fair market value at the date, we subtract away the adjusted basis of the date, so we're using this date that Green Apple joins. So even if the 754 election's always been in place since the very beginning, we still apply the numbers when Green Apple joins, which is on this date. We take the fair market values minus the adjusted basis, and we get the gain or loss amount. So, of course, cash is not going to have gain or loss. Accounts receivable, we have 75 minus, 60 minus 75, my apologies there. So we're just taking these numbers given to us. 60 minus 75, that gives us $15 loss. Inventory, we've got 150 minus 90. Machinery, that gives us 60. Machinery, we've got 100 minus 55. That gives us 45. Building, we have 500 minus 200. That gives us 300. Stock, we have 300 minus 90. That gives us 210. And then goodwill, we have 300 minus 0, and that gives us 300. Sorry. We then multiply that gain or loss by Green Apple's percentage, which of course is 1/3, because Green Apple is acquiring 1/3 and joining. So we multiply each of these numbers by 1/3. Just go ahead and put a line, because it's the same number. Zero, -5, 20, 15, 100, 70, and 100. So these amounts, we now keep track. This amount is now considered Green Apple's portion attributable to each of those assets that have already been recorded. So whenever you do tax accounting, this is why when it comes to partnerships, accounting firms are almost always involved with partnerships, because there's so many different books or so many different tax worksheets and records. You have to keep track of all these different, whenever an event occurs at 754 purposes. Now Green Apple has these amounts attributable to each asset, which creates a new worksheet. in Excel or whatever you want to think of. And we also increase the adjusted basis of each asset by these amounts. So the new adjusted basis for cash, well, you add these numbers. So you take the adjusted basis and you add. Still going to be 240. Accounts receivable now is going to be 70. Inventory is now going to be 110. Machinery is now going to be 70. Building is now going to be 300. Stock is now going to be 160. And goodwill is now going to be 100. So that is the new adjusted basis. And that increase is purely attributable to Green Apple. So what I'm saying is that now when Green Apple goes through the analysis for the sale of partnership interest, this has already been recorded. Anything beyond that would go to Green Apple for a hot asset, but because it's problem, nothing has changed unrealistically, right? There's no change there. So now when we do step 2, the hot assets are all going to be 0 for Green Apple because now this adjustment has been taken into account. But what if between that time, lemon or orange left? Well, then this amount, this new basis would be used, but then their old portion would be still intact, right? Their old portion would still be there. So that's why we keep track of this new set of records now. So if lemon or orange left, they would have that attributable amount, but Green Apple, basically the idea is that the portion that was attributable to lime is now starting fresh for Green Apple. Now we go through our analysis. If we have a 754 election in place, step 1 is the exact same. Step 2 changes, and we go through the hot asset analysis, and you would find that for each of the hot assets, accounts receivable, inventory, and machinery, the portion, right? Remember we had Lime's portion? That was this -5, 20, and 15. Because no transactions have occurred in those 3 years, that's the same amount that was attributable from Lime to Green Apple, and there'd be 0. It'd be 0, 0, and 0. And that brings it to 0. Again, if we did have transactions, you'd have to go above and beyond that. You'd have to go from that amount, that baseline, that 754 adjustment baseline. Then that brings us to step 3. Step 3, it's like, hey, we take step 1, step 2, both are 0. Therefore, step 3 is also 0. So notice, with no 754 election, you have a $30 ordinary income, $30 long-term capital loss when there's no 754 election made. But if there is a 754 election, it's just 0 across the board. And this 0 across the board is much better for a taxpayer. Now, some of you might be wondering, why would a partnership not make a 754 election? Because wouldn't it make more sense? What if there was a situation where there was an ordinary loss? That would be beneficial to the taxpayer. Because then you would have ordinary loss to the taxpayer, and then you would have capital gain. And that would be good. That's very rare, though. But you have to think about that situation, right? Again, think about, what if the accounts receivable was the only hot asset here? Well, then, when Lime sold it, there'd be a $5 ordinary loss, which is better than a capital loss. So that's good. And then when Green Apple comes in and sells again, Green Apple also gets another bite of the apple, not, pardon the pun, gets another bite at the $5 loss, and gets to record a $5 loss as well. Even though technically Green Apple, so there's another $5 loss. So it's a two-way street. It could benefit the taxpayer, but mostly it burns the taxpayer. So that's why most partnerships make the 754 election. They also do it because this makes more economic sense, and it also makes sense when you look at revaluations and stuff. One other thing I want to mention is we talked about how Green Apple's, or the partnership's new basis in all the assets, we calculated that as well. That's all of this right here, right? So if you're looking at the balance sheet, right, these would all change. These adjusted bases would all change now. Well, the cash would stay the same. But the accounts receivable, that basis is now equal to 70. Inventory is now 110. So that's what I mean, all of those. And you would add all those up. The fair market values will still stay the same because, again, nothing has changed. And then Green Apple's amount here, this is going to change to 500, which makes sense because Green Apple went into the partnership paying 500, so that should be the capital account book and the fair market value 500, right? So we have 500, 200, 200. This is now 900. So this is going to equal 1050. When you add all these up, you'll get 1050. So the bases of all these added up are now 1050. Okay? Fair market value is still staying the same because, again, transaction-wise, nothing has changed. All right? So that's really how everything fits together when it comes to 754, sales of partnerships, purchases. Please watch the videos on distributions because, again, that's another element in itself.